Hello, everyone. This is Dr. Duru from Ahan Analytics with the market breadth. The tariff noise is back. All right. So I enjoyed this time period of peace and ceasefires from the tariff pause on the reciprocal tariffs and the walk back on the China tariffs. But it looks like we are back into the tariff drama, trauma, and noise. You can see the headlines here. This is the timestamp, May 23rd, and the headlines from Yahoo Finance. Trump threatened a 25% tariff on iPhones that are not made in the US. I think this also applies to Samsung phones. And you can see this headline's kind of funny. Tim Cook was clearly scrambling to try to avoid the situation because there's just no way that Apple is going to be making iPhones in the US anytime soon. And even if they pull it off, it will be so expensive that Apple sales will drop. I actually looked at the trends and bought the inverse Apple bearish ETF. And when I show the Apple chart, you'll see why I pulled the trigger on that, even though overall I'm bullish on the market. Okay, so some other headlines here. I'm going to go into Informatica. That was an interesting trade for today and hopefully for next week. And Decker's Outdoors also on my list. So let's go ahead and jump into it and see where we are with the indices. Actually, let's first start with market breadth. And I'm going to go into, yes, the regular scaling. And you can see here that I posted a quick short explaining that the drop from the overbought threshold at 70% for the percentage of stocks trading above their 50-day moving averages, what I like to call AT50, this is a pretty ominous drop. Now, under normal circumstances, I would have flipped bearish, and this happened on Wednesday when the market had a big pullback. I think that was budget related, or sorry, yield related, and yields were going up because of concerns about the ever ballooning budget deficit. And this latest budget bill is going to blow out the deficit even more. Anyway, you could see that indeed the market continued to drip lower, at least far as market breadth. And so that kind of confirmed the signal once again. I mean, it's amazing to me how well AT50 does in terms of being a market breadth signal that signals trades. But I did not pull the trigger in terms of flipping bearish because, and let's take a look at why I did not. And again, I put a quick 15-second short on this to explain it. But you can see that the S&P 500 was well supported, both by this post-election gap. Sorry, this line that shows where um, the post-election open was. Sorry, the pre-election open. Sorry about that. And also that's converging with the 200-day moving average, which is the blue line. So that looks like pretty strong support. Now, magically, on today's news of more tariff trauma, drama, and noise, the S&P 500 gapped down and opened right at this support. And buyers, I think, thinking that the mode was, oh, sorry, let me go into logarithmic, thinking that, of course, we should be in this mode of peace and ceasefires and walking back and carve outs and tariffs don't really matter much anymore as far as a market mover. You can see buyers jumped right in and bought. But we had a very weak close, which tells me that the tariff noise is going to loom louder for a while here. Let's actually take a quick look at the 15-minute chart and see the pretty steady downtrend for most of the week. You see this red line here? This would be the 15-minute average line, and it is trending down. In fact, it peaked on the 20th of May, which was a Tuesday, and it guided the index downward. Now, I'm not saying that this line is going to hold forever. Of course it won't, but it's very interesting to see how consistently it held. Now, what are the implications for trading? Well, it means that short term, the trading trend is down. You can see that here. And let me zoom in a little bit. You can see that here, but with this support here, I went ahead and bought a calendar call spread at the 500, and I think it was on SPY at the 590 strike. And my thinking here is not that S&P 500 is going to blow up above this in 2 weeks. It's more that I think it's going to drift higher and allow me to take advantage of some decay on the shorter term call option whereas the longer term call option will decay slower. Sorry, and the shorter term call option will decay faster. So that's really the only play that I'm making here. This is basically trading within a narrow band. I don't expect much upside up here above this line, which is the first post-election close. And I'm assuming that this support here will hold. And actually, you can see the 20-day moving average, which is the dotted line, is also converging to hold a support. So all that to say, if the S&P 500 closes below this very strong convergence of support, then I'll have to get a little bit more bearish, or at least, sorry, I'll move from cautiously bullish to neutral, which will open up the possibility of more bearish trades. And I will definitely have to flip bearish if we get below this 50-day moving average line, which is the red line. And what are these levels? Well, right now we're at 5,600 for the 50-day moving average. And for the converging support I just mentioned, let's say that's around 57.82. Okay, so those are your levels. The NASDAQ is trading very similarly to the S&P 500, but it is still comfortably above the 200-day moving average support. So if I were to look at this as a trade, I wouldn't do anything because it's kind of the NASDAQ is just kind of hanging in limbo here. I would wait until it tests this converging support of the 200-day moving average and the 20-day moving average, which puts it around 18,424. Now, my big disappointment for the week was small caps. IWM, it finally broke below this nice uptrend that it had been following for a while since the bottom in April. And per my strategy, now that I care about IWM again, I did buy a call option here. Then I bought again, hoping that the 20-day moving average support would hold, and it did not because of today's new tariff news, of course. And so now I'm kind of in trouble. I think that there'll be one last support level that I probably will buy here at the 50-day moving average, which is IWM at about 197.75. But if it breaks below that, you can see it'll get essentially right back close to this bear market line, and I'll have to take IWM off the shopping list at that point. So for now, I'm betting on a bounce, not much of a bounce anymore. I was hoping that this trend would continue all the way up to the 200-day moving average, which puts IWM about 216 there. So that's what I was playing for, but that's now off the table. So that was the big disappointment of the week. Okay, let's take a look at the VIX because the VIX acted when I talked about the VIX last time, or maybe it was maybe 2 weeks ago. I was talking about how, actually, a week and a half ago, how it looked very suspicious how the VIX, consistently downtrended and then slowed down right here at this previous low, which preceded the last tariff noise. Now, is it coincidence that we have more tariff noise as the VIX is bouncing off that support? Who knows? But that's what is happening. And of course, now the VIX has come alive. It's back above the 20 level, which is considered elevated volatility. So this is something to watch. We were back in high volatility mode. And given that we're coming off of a bottom, this means that we should expect sharp pullbacks at any time and any moment. So stay cautious and alert. Okay, let's dive into some ETFs and stock indices. XRT, which is the SPDR S&P retail ETF, failed to hold this 200-day moving average breakouts. You could see I was waiting for a confirmation to buy it. It almost confirmed here on the second day, the third day of the breakout, but the close is so marginal. The close is so marginally higher than the first breakout that I didn't bother, and good thing I didn't, because on Wednesday's pullback in the market, XRT lost 3%, 3.1%, and couldn't recover above the 200-day moving average, which means that I'm taking it off the list. And in fact, it would be a candidate for a short for any if I wanted to get aggressively bearish. Okay, let's go. Actually, I said that my biggest disappointment was IWM. Actually, my biggest disappointment was Fair Isaac Corporation, ticker symbol FICO. I don't have time to get into the complexities of why it collapsed last week. All I can say is what I can say though is that I somehow missed this first decline of 8.1%. And that would have been my sell signal. You could see the high volume, the high selling. I think there were enough headlines to convince me that I needed to preserve my remaining profits at this point. but I missed the signal, and then it just sliced right through support at 200-day and 50-day moving average and lost another 15.7% on Wednesday. And that wiped out all of in just a day and a half, wiped out all of my nice gains in FICO. I was very disappointed because I played this one pretty perfectly around the technicals earlier in the year. And if I scroll back, you can see just how beautiful this long-term uptrend is in FICO. And this is just since 2017. So now, sorry, if I pull back again, you could see that what's at stake here is that FICO for the first time looks technically in trouble and could be topping out, which is not on, that was not on my radar that FICO would top out. But this news that's happened looks pretty serious. So I'm just going to have to lick my wounds and take my losses if FICO closes below the low from April. So that's what I'm looking out for there. Biggest disappointment of the week. Okay, let's move on to back to retail, TJ Maxx. I'm pulling up this one because, TJ Maxx has been a very consistent performing retailer. It's kind of the go-to when people want to play retail, and it actually had poor earnings or poor enough earnings to generate a 2.9% loss. And then it finished the week closing right at its 50-day moving average, which is $125.70. So it fell another 3%, let's say. This is not one to short. It's just one to look for the next pullback for a buy. So, if it gets back to the 200-day moving average, I would look at this as a buying opportunity for a longer term hold. I have yet to play or trade TJ Maxx, so I'm looking forward to this opportunity if it does come. And that trading level at the 200-day moving average is around 121 for TJ Maxx. Google was a yo-yo this week. I had rolled over a call option from the previous week into a call spread, and I thought that 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 trade had failed until Google suddenly came alive on Wednesday, of all things, when the market was pulling back. Google was popping by 2.9%. This was a positive reaction to Google I/O. It traded above its 200-day moving average and then it pulled back. And then I just took my profits there. I didn't want to risk, because it expired today, Friday, I didn't want to risk losing all of my profits. But the momentum continued the next day, but then this big fade from the highs of about 177.76 was the big warning signal. It took Google right back to its 200-day moving average, and then today it lost 1.4% and it's back below that. So I'm just going to stay out of this mess in the middle between the 50-day moving average and 200-day moving average and just wait for the next buying signal, which would be a solid close above the 200-day moving average and a second close above the 200-day moving average. So that again, that level is about 172.60. Okay, U.S. Steel. I really regret missing this one. I saw a signal. I think it was yesterday, Thursday. I was surprised to see X was on the move. In fact, Wednesday it was up 2%. Then the next day it was up another 2%. And I just forgot about it. And then today we had this big surge, 21%. You may have seen the headline on the Yahoo Finance that Trump is now supporting a partnership, and I'm putting that in air quotes because I don't know what a partnership means given Nippon Steel wants to buy out US Steel. But they passed the security review, so it's all systems go for some sort of transaction and deal. Who knows? So this has been an interesting drama. I'm just going to pull back to show that all the big chop in US Steel. I did trade it on one of these big drops and then sold it on the next rally. There's no way I could have held through all of this chop, so I'm not even regretting taking profits back then. But today is obviously a big day for US Steel. Congratulations, and that is ticker symbol X. Okay, back to retail one more time. Well, not one more time, but again, Decker's Outdoor Corporation, pretty much, it collapsed 20%. Let's see, it went right back to the lows from the April tariff trauma and drama. That means it has round tripped those gains, and this is a stock that is now in trouble. I didn't have time to study what was the problem with their earnings, but this just says everything you need to know. Technical wise, Decker's topped out all-time high around 220. it's been chopped in half again. It got chopped in half at the April lows and now it's back down there. So a stock that has fallen like this is bad news in my book, and I don't want to touch it from the long side. I'd be looking to fade it if it were to rally, for instance, back to the 50-day moving average. Okay, Landstar System, LSTR, is a stock that I said I would keep track of to see how the market really feels about the impact of tariffs on trade or just what's going on with trade dynamics. And because it does a lot of I think it's trucking and logistics that's related to international trade, particularly from Mexico and Canada. Sorry, I should say through Canada, the U.S. and Mexico. And you can see that it did not benefit that much from the tariff pause, the reciprocal pause back in April. In fact, it started to drift right back down to those lows. And then it did pop when there was a ceasefire with China on trade. And then earnings came out and the market had a tepid response. And now it's drifting back down. And of course, today's news, tariff trauma, is only going to weigh on Landstar even more. So this tells me that we need to stay on our toes. I mean, this meaning the downtrend on Landstar tells me that we need to stay on our toes, that this tariff drama is far from over and it's going to come back at any given time. And also, this tells us that the trade, the system of trade is probably in trouble. And when it starts to finally flow through other earnings, watch out below. But who knows when that's going to be? Because right now the market absorbed the last earnings cycle pretty well. CEOs and executives told, I guess, good enough stories to keep people at ease for now. So we'll see what happens in the next earnings cycle, which would be July. And I think, we'll probably, well, anyway, I'm not going to guess, but just stay on your toes. That's the bottom line here. Okay, INFA is another interesting trade that happened today. And this is one where I have written about this before. Info was one of my favorite stocks. I finally had to give up. Let me just pull back and you could see the chop here. Um, it had rallied up to this peak in 2024 on rumors that Salesforce was going to buy them. And then when Salesforce either denied the rumor or backed out, it gapped down here. What was that? That was a big 10% loss. But I held on, hoping that either CRM would come back to the table or the news would turn out to be true, or maybe some other suitor would show up. But it never happened. And it earnings weren't even enough to keep Informatica in the game. So it dropped again and dropped. And I think I can't remember quite well now whether I sold before the big drop in February or whether I finally gave up on this big 21% collapse on earnings back on February. But regardless, I know I took a loss. It's very disappointing because I really believed in this company, but I did keep my price alerts on. And today, this morning, an alert went off that Informatica, ticker symbol INFA, was up 6%. I quickly went into action. I looked and looked and looked, didn't see any news. I looked at the options trading. Sure enough, call options were flying off the shelves, meaning a lot of calls were being bought. And I just jumped in. This was an easy one for me because I previously loved this company and this stock. So I went right in assuming that something, I'm putting that in air quotes again, was up. At least the market was acting like it knew something was up. And shortly after that, news did break. And I shouldn't say news because I'm still not sure whether it's in rumor form, or whether it's news that Salesforce is interested in Informatica once again. So the stock continued to soar higher. I sold my call options because I got a double, which is pretty nice, a double in less than an hour. The trading rules on that one is you have to take those profits off the table. I kept the shares that I bought, and I'm just going to hold them and see. You can see in the post market, the stock continued higher, another 6.6%. But magically, look at that. The 200-day moving averages blue line held as resistance during the regular trading day. So let's see what the next week brings. Um, Even if it turns out to be another false rumor, I'm hoping that at least Informatica can hold these lows, and then I can build back into a position because I think stocks like these and companies like these could be on the table, particularly after the new budget bill and the tax cuts come in and companies feel more confident about spending up their money buying other companies with their tax savings. All right, so that's Informatica, and this is a good segue to another stock that I did a quick 15-second short on, which is Domo. And this is one where I wish I had actually bought ahead of earnings because I was a Domo user. I was introduced to Domo about first introduced to it 3 years ago at a company I worked at, and it was so-so. A lot of complaints from my colleagues at the company I was at, and so I wasn't all that thrilled about Domo. But fast forward to today, and I'm on a client engagement. I'm now doing data analytics consulting, and Domo has greatly improved in this time. And I'm just amazed at all of the features, particularly for data science. And I had it in my mind to buy into the stock because let me just pull back here. You can see it's been beaten up thoroughly. And this again is because I think a lot of people were like my colleagues at the former company, just did not like the platform for various reasons. I won't go into them, but I think they're finally turning around. And this big earnings surge, I think confirms that they are turning things around. But I missed the surge, of course, and it also is now overextended. Post earnings, it gained 26.9%, and buyers piled in again and pushed it up on high volume another 4.6%. This is overstretched. I can't and don't chase these things just as a trading rule. And I'm hoping on a pullback it can get to 10. $10 is what I see as perfect support because that would test the previous high, the high prior to earnings. Or, this is essentially a breakout to, I think, 14, almost 15-month highs. All right. And the reason why this is a segue from Informatica is because Domo, just like Informatica, is an analytics platform. And these platforms are going to become they're getting easier and easier for more and more people to use and more powerful given all the data science features. So I think a lot of these companies could be in play, the smaller ones, particularly the ones that have been beaten up in stock price. So I'm hoping that I can get a decent price on Domo ahead of any kind of additional positive catalysts. What those might be, I can't predict, of course, but I just have a strong feeling and intuition given my experience using the platform now. Let's conclude with Booz Allen Hamilton Holding, ticker symbol BAH. It is a consulting company and it crashed 16.5% post earnings. It brought back into investors' faces the impact that all of the budget cuts in the federal government are going to have on companies like this. And I think we're going to see in coming months, it won't just be consulting companies and contractors. It'll be other companies as well will be affected who depend upon those contractors and consulting companies for their business. So the cascade is moving. It's moving very slowly. The market overall showed very little concern about it, any of that activity. But Booz Allen Hamilton brought that back, like I said, back into the radar. It didn't crack the recent lows for the year, but I'm on alert for it to do so. You can see that it had a great run in 2023 and 2024, and that run is all but over, is essentially over. But it's a good franchise, and if it can get back down to, I don't know, where it was in this trading range, say 83 to 100, somewhere in there, I think I could pull the buy trigger for a long-term hold. But I don't want to one step at a time. Let's see how the post-earnings stuff trading unfolds in coming days, weeks, and months. All right. Well, thanks everybody for checking this out. Don't forget to hit the subscribe button. You can hit the bell if you want to get notified for future content like this. As always, I appreciate shares and likes because that helps the algorithm know that this is great content that more and more people should see. And if you have any questions, put them down below, or if any feedback, you can also put them there. Otherwise, you can check out my blog for more details where I write about the financial markets and the economy and so on at drduru.com/122, all letters. Thanks again for checking this out, and I will see you the next time.